There's no avoiding this now. I'm your host, Steve Van Metre, and thanks for joining me today. And we just got some brand new data this morning that indicates the global economy is in far worse shape than we thought. Now, when we look for data, we're always looking for what are called leading indicators, things that give us an idea of where the global economy is headed, because the government data, as you know, is generally lagged anywhere from a couple months to several months beyond that, and it's often smoothed out. But what we got this morning indicates that something just happened in the global economy in November. We're seeing data fall off the cliff, and we're not likely to see us hit the government data perhaps until either January at the earliest, maybe even February or March. So what we're seeing now, again, the base case was we were going to slow down and have a recession sometime, maybe mid-2023. You remember that's what the policymakers have been telling you. What we're now seeing in the data suggests we're looking at something far more severe in the first quarter. So let's head over to CNBC. We'll take a look at the story, bring you up to speed. And again, thank you for the continued well wishes. My voice and my eyes do not reflect how much better I feel. So hopefully within about 2 days from now, we'll be back at full strength. And what you see is coming, well, don't worry. I'll be with you the whole way through. All right, let's head over to CNBC where we got the headline, freight rates from China to West Coast are now down 90% as global trade falls off fast. Now, your question may be is what are freight rates, right? We talked about on a show the other day about China and how demand from their factory sector was crashing. We talked about how container demand was falling. We talked about how shipping demand was falling. And now we're talking about the price to ship things from Asia to other parts of the world is outright crashing. And this, again, is not inflationary. This is disinflationary. And as we get into the numbers, we can see real quick next year how this could be outright deflationary. Shipping firm HLS recently wrote to clients, we initially expected the market was about to correct itself and normalize sometime in 2023, but it comes much earlier than we expected. And again, this is just following what all the policymakers are telling us is don't worry, mild recession, mid-2023, we know we're slowing down, we're coming out from a real high point, and now you notice the change here. What does the language say? Hey, this is not what we expected. And we're going to hear a lot more of those words in the months to come as people start to realize that we aren't on a slow glide path down. Perhaps there was something that occurred along the way, we'll get into this in a little bit, that put us potentially at an economic cliff. And now we're starting to see signs of that. The peak in the market, according to Alan Baer, the CEO of OL USA, was the second quarter. From there, a steady decline, he said. The market may have reached the low point in November, but added it is still too early to tell if this is a trend. And again, we'll hear this again that, well, we're hoping it doesn't get worse and maybe this was just some anomalous data point for November and everything will normalize in December or perhaps January. You often wonder why policymakers or experts get things wrong is because they hope that perhaps the data isn't going to get worse. And the answer is simple. Well, if we see a bad print, we'll just wait a couple months and see if it's truly an anomaly or not. And so now we've seen them already start to wonder if this is just the beginning of something worse or the bottom. Trade data shows a decline in Asia imports to the U.S. by a whopping 11% year over year in October. Now, this, again, shouldn't be much of a surprise because we talked about this in the show the other day, which built on a September decline. So, again, we're seeing multiple declines here, and we don't find any grounds for optimism in November. And based on the data we're going to look at, there is no optimism for November. The only question is, will there be optimism for December or January, or are we going to see perhaps now the beginning of an acceleration to the downside? But let's dig into this import data and then come back to our story here because I think it's pretty eye-opening about what it's telling us is coming. U.S. trade deficit widens on greater imports, drop in exports as the deficit gap grew in October to $78.2 billion, the most since June. And this is actually pretty good of what you want to see. Now, the value of goods and services imports to the U.S. rose 0.6%, while exports declined 0.7%. Now, when you have the world's largest importing nation, that is the U.S., the biggest consuming nation in the world, what you actually want to to see is imports rising and exports falling. This is actually what is considered pretty much normal. So at face value, you look at this and say, hey, well, this isn't so bad. You're right. This is October's data too. You know, what we're talking about is government data here, and what we're seeing from the shipping data as we get further into that story is that's November. So again, right now, everything says, hey, looks okay. But what we can note is this import of goods, balance, and payments. This is imports into the U.S. on a year-over-year rate of change. Now, you might be looking at this chart and say, Steve, this looks obviously, ominously familiar. In fact, I think we've seen this chart in a different form in other ways. And the answer is you have, because look what happens when we overlay the consumer price index in red. And you say, wow, there is a staggering relationship between these two. And as imports come down, well, that means inflation to the U.S. is coming down, because that's a sign of demand. Because when the world's largest consuming nation says, hey, either we've got too many goods now, or maybe we don't need as many going forward, it's not a sign of inflation. It's not a sign of too much demand. It's a sign that demand is coming down. And so that's why we look at this import data and apply it to inflation. And now you can apply it to what the Fed is going to do here in a couple weeks in December. Highly likely they'll raise rates. Now, I know I thought this was a last hike, and maybe they will be a surprise and they'll pause, but it's now setting up for the likely very last hike as we head into a pause in January, because what will happen is the official government data is going to start to catch up to what's really going on in the world. Meanwhile, foreign demand for U.S. goods and services remains soft as many economies contend with persistent inflation and rising interest rates. And even though the dollar has erased much of its advance this year in recent months, the strong currency is still making U.S. goods more expensive for overseas customers. And this is exactly what's also supposed to happen. Again, the rising dollar tends to balance things out, and what it should do is reduce exports out of the U.S. It should do that. And what happens over time is as demand for U.S. goods to the rest of the world falls, then the dollar should alleviate its pressure, come down, and the system sort of balances itself out. So everything so far looks normal. What doesn't look normal is what's coming in November. The ocean freight contract market tracked by Exenta's global XSI recorded a drop of 5.7% in November, and this is one of the key things. The third month in a row rates have dropped. And remember, we're always looking at the trend and the largest month-over-month decline. Again, so you have 3-month trend, largest month-over-month decline recorded since this data launched in 2019. Now, of course, since 2019, it's not a whole lot of data to work with. We've seen largely, other than the pandemic and expansion of the global economy. But when we talk about what's going on here, a lot of people said, how can you be so confident we're going to have a global recession? It's simple. If you go out and dig out all the books on the history of monetary policy, or things like money printing, currency debasing, massive easing of interest rates, quantitative easing, what you find is when you expand the economy through tools like that, and then you pull them back, perhaps because inflation gets too hot, and now you withdraw the monetary and fiscal support. When you do that, the economy naturally has to shrink backwards, and we did that. And so now we're starting to see the initial effects of that. Because if we go back to Milton Friedman's research, you remember what he said about the monetary lags? I know we've talked about this on the show. Do you remember how many months? Well, he said 6 to 12 months. And you know what we're getting really close to in March? That 12-month mark. So perhaps what we're starting to see in the shipping data here is the early signs of the global economy now contracting backwards due to withdrawal of all the stimulus. They go on to say for many carriers, the fall in the XSI will trigger a fall in their average rates and will bring an end to record-breaking quarters. What they're referring to is freight rates coming down. The change from a supply chain that struggled in trying to keep up with unprecedented pandemic demand. Again, this is just what I was talking about. Unprecedented pandemic demand to a weak demand environment and a freight market now oversupplied with both ships and containers highlights the risk of prolonged downturn in the global economy. And again, this is exactly the story here, right? We had this unprecedented demand during the pandemic. Why did it happen? Global fiscal and monetary stimulus, and that is gone. But what did all these companies do? They reacted to it. They said, look at all this demand. We need to do what? build more ships, build more containers. Well, there's going to be this unrealistic, unprecedented demand for years to come. We're at the beginning of a whole new phase of consumption. And now what are we seeing? Let's go right back to this. What do we see? A market now oversupplied with ships and containers highlights the risk of a prolonged downturn. And what is that telling us? That means we don't need to build more ships. We don't need to build more containers. So those people that have those kind of work, hey, we don't need you anymore. What about the ships we do have? Well, we got too many of them. So what are we going to have to do? Get rid of some of the old ones, scrap them, get rid of these containers, where everything's going to have to adjust downward. And that's why, again, we cannot avoid what is coming now. It's all baked in the cake. Extended data indicates 85% of customers' plans to decrease ocean freight spending in 2023, a staggering amount, while 42% say their volumes will stay rather stable or consistent with 2022, which SAN says suggests a further decline in cargo volumes. Again, all of this says the economy is shrinking, and how do we know what our leading indicator always was orders. We talked about this all the time. New orders are definitely down, volumes are down, overall vessel utilization, and that means how much of a vessel has cargo on it, is down, even with large number of canceled sailings. Again, these are not things you hear about when you're talking about an economic boom. This is recession data, and we're not even in a recession yet. Now look at this next page here. You're going to see just how bad demand is getting. According to Freightos, despite the increase in canceled sailings, which has cut vessel capacity, the hemorrhaging of ocean freight prices continues. From Asia to U.S. West Coast, prices fell or down now 90% lower than the same time last year, not inflationary. Asia to the East Coast, 78% lower for this week last year. Asia to North Europe, 73% lower than rates for this week last year. Do you start to see how we're setting the signs for a deflationary event now? I mean, this is just ocean freight pricing. And again, we're not even at a point where U.S. consumers have cut spending yet. It's staggering what is coming. In 2023, there is a high possibility of an all-out price war. It doesn't seem that the capacity restrictions that we've seen in the past 2 years are due to return. So we'll just have ample capacity, both on the vessel and as well as the container side, with competitive dynamics in the container shipping and liner industry. I don't expect especially big players to hold back, and we do expect prices to come down, almost variable costs. We foresee market consolidation because, again, you can't just go park one of these ships and say, hey, you know what, I'm just going to dock it over here for a while and I'll get to it later. You've got expenses. They need maintenance. You need to staff them with a crew. I mean, these things just don't idle well. And you start to see this bigger picture of where the global economy is going. And we can even see it inside some of the U.S. data, which we didn't expect to see. We're not supposed to see the services sector decline, but it starts to all build to the broad narrative now. The S&P Global U.S. Services PMI, look at this. Business activity contraction gains pace as demand conditions weaken. There it is in November. Quicker fall in new orders in the services sector weighs on services sector output. Look at here, the global composite PMI from S&P Global. Private sector output contracts at a faster rate amid renewed fall in manufacturing production. It's saying everything's going down. Draw this arrow here, says, hey, recession's coming when we look at GDP data overlaid against our composite output index. It doesn't get any better when we look at the ISM, which is considered the gold standard of the two surveys, even though it tends to lag the S&P Global. Look at the S&P, services PMI here. It says 56.5, growing faster. But look at new orders, growing slower at 56. This is a November backlog. Here's your inflation component, growing at a slower rate, about to turn negative. Export orders contracting at a faster rate. All signs are indicating to a slower global economy. And there was one thing we could have pointed to, we have pointed to, we've shown you on this show that we knew this was coming. Here it is, the Philly Fed current new orders diffusion index plummeting to levels that we normally do not see until we're in the depths of a recession, indicating, my friends, things here are far worse than we think. If this is just a one-off print in November, okay, that's one thing. But watch what's coming in December. It's likely to get a whole lot worse. And that's how we know now that we can't avoid the next global recession. It's baked in the cake. It's coming. I hope you're ready, because I am. And I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.